All right, Matt the Mortgage Guy here, recording a quick video to talk about mortgage guidelines. What are they? Why are they there? Do we have to follow them? This video is brought to you by the dozens and dozens of clients who have pushed back on me over the last few months on different mortgage guidelines. And I'm not sure why. I don't know if 2020 and 2021 brings up something inside the human spirit that just wants to argue or push back. But I'm making this video to just say publicly to anyone who's wondering, the mortgage industry, like a lot of industries, is regulated. There's rules in place. These rules are not set by me, the loan officer. They're not even set by the lenders. They're set by the government entities that are buying up batches and batches of mortgages. They write the guidelines. They tell the lenders, hey, if you're going to write loans and sell them to us, here's the guidelines that you need to fit into. Here's the debt to income ratio. Here's how you're going to calculate income. Here's what we need as far as assets and how you're going to prove to us that somebody has the assets to close on this, the bank statements, the funds. And when I ask clients, or my team politely ask clients, hey, we need this or we need that, we're not doing that because we want to collect more documents, we want to make it harder on you. We're doing that because the lender requires it. The lender requires it because it's required to sell the loan off, which is what they do. Every single lender who writes a conventional loan, an FHA loan, a VA loan, they're bundling those up and they're selling them off. They're selling them off to somebody who has already written the playbook. Here's what you need to present to us. Here's what you need to have in that file, or else we kick it back and you've got to eat it. And so I've had a lot of interesting conversations lately, and I love analogies, right? And so you can look at a bunch of different businesses, and let's say, for instance, you are a client, and I say, you know what, the underwriter's asking for us to break down your income. You get paid a base, you get paid a bonus, you get paid commission. So it's not just that you make $88,500 a year or $173,200 per year. It's broken down in different segments. The lender wants to see on a verification of employment from your employer exactly what's in each bucket. $120,000 is base, $38,000 was bonus income, and $24,000 was commissions. And then in 2019, your base was $105,000. And your bonus was $34,000, and your commissions were $19,000. In circumstances like that, they've got a specific formula they need to follow. They need to take 2 years. They need to average out that bonus, average out that commission. And they can take your full new base, because that's a base income. They know it's not going to change. That's not going to fluctuate. But they saw through that verification of employment that the bonus fluctuates, the commission fluctuates. So we'll take an average of that and we'll add your base. It's examples like that where this stuff isn't made up. It's not like I'm asking you for stuff just for shits and giggles. It's required. And so I had this come up on a file. I know the most common pushback, and I agree, is, hey, listen, I make plenty of money. I'm well qualified for this mortgage. I've got enough in the bank to pay this thing off. Understood. And this is where it comes up, I think, more often than not, is somebody who's fairly well off. They're very well qualified. And if you looked at it from the perspective of like, do I think this person's going to pay the loan? Slam dunk, 100%. But that's not how loans are underwritten, following a specific set of guidelines. Whether you make 60 grand a year or 600. And so I got to explain to the guy that makes 600 that your income is broken up into 4 different parts. The underwriter needs to see it, no matter if you qualify by a long shot or qualify by a little. Your pay is not just strict base 600,000 a year. It's 325 in this, 175 in this pay, and it's broken down. So for the medical professional that makes 600 grand, that's just a requirement. Just like it's a requirement when I go, and this is an example I gave recently as an analogy. I contact my primary care physician. I want to get blood drawn just to check my levels. I want to be on top of my health. I want to kind of monitor things. Let's do a full panel. You do a physical once a year. It's a good idea to check different things like cholesterol and different levels in your body, right? I'm getting old, I'm 40 now. So I order that through my primary care. I have an appointment. I have a portal where they can see my doctor has records that I've requested that. Then you set the appointment with Quest Diagnostics because they've sent the request to them. I log into Quest Diagnostics portal. I agree to a couple things there. Requirements that they have that you've got to agree to this and that. And I schedule an appointment to go get blood drawn. And I go in to get my blood drawn. I sign in. I agree to whatever terms they have. It doesn't matter my opinion on it. It's their standard. It's what the regulation is, per HIPAA or whatever the medical stuff is. That's what I have to do, right? And so I go in the back. I'm ready to get my blood drawn. And the gal brings me a sheet. I've got to sign it, giving them permission to share this stuff with my doctor. Now, if I was a person who wanted to question things, I go, no. I contacted my doctor and made this appointment. So of course I want to share it with my doctor. Or I scheduled the appointment with Quest and you've got all the connections in the system. It's assumed, right? No, it's just regulation. They have to have a signed document, just like I have to have certain documents in a loan file. And so, I could give example after example. You go to a bouncy house with your kids. Are they going to make you sign a waiver before your kids can jump around and potentially break an arm? Yes. Somebody says, they've got an excuse where it's, assumed that I brought my kid in here. Of course I know they can get hurt. I don't need to sign anything. That's the rules. It's the regulations. If you're in California, there's a lot of lawyers, a lot of lawsuits. And so things get signed and stuff gets followed, whether you're in the mortgage industry, whether you're in banking, whether you're in medical, whether you're, liability because you own a jump house or something like that. So moral of the story, when you're getting a mortgage, there's going to be requirements. There's going to be requirements at times that you think are not necessary, and it's nothing personal. They want you to write a letter explaining why a certain address showed up on your credit report. That's my parents' address. I haven't lived there for 26 years. Okay, write the letter. They want it in the file. So when they sell the loan off, it's a requirement to explain why this address showed up on a credit report. They're going to want silly things at times. You got divorced 16 years ago. Some lenders might ask for that divorce decree. It might be a pain. There's sometimes, here's the slippery slope, right? Sometimes you can fight a condition. A divorce is 16 years old and you don't have any small kids, so there's not going to be an alimony. We're not going to provide that. Let's just write a letter explaining that. Okay, now I put the letter in the file. Can't fight all the conditions though. There's some stuff that's just hard and fast. It's a requirement. So hope that clarifies things. Be nice to loan officers. Don't fight them on conditions. They're just doing their job to package your file up nice, get you a great interest rate and get you on your way. Bless you. Matt@mattthemortgageguy.com. If you're in California, I'd love to help you. If you're outside of California, I'll refer you to somebody who can. Thanks for watching.